Hello and welcome to the ESG Megatrends part of the summit. Today I'm joined by John Hale, who is Global Head of Sustainable Investing Research at Morningstar. He also writes an ESG blog on medium.com simply called End of Week Notes, and it's one of my favorite regular reads in the ESG space. Also joined by Graham Sinclair, ESG architect who runs his own ESG advisory boutique, Cinco, and he is the host of his own ESG podcast series called ESG and Coffee. In addition, he is a lecturer on the ESG topic at Harvard University and also at Villanova University in Pennsylvania, where he currently resides. Co-hosting with me today is Ray Naude, ESG analyst at Allan Gray, and my name is Duke Sasaji, and I'm a business analyst at Orbis Investments. So a big warm welcome to everybody. So ESG investing, it's all over the news and on any given day of the week. And as the segment title says, it really is one of the mega trends of our time. And last month, many people undoubtedly saw the IPCC report, and it painted a pretty bleak picture for humankind, showing that we're on a trajectory to exceed the 1.5 degree warming targets set in the Paris Accord by 2050 across all their modeled scenarios. But in that report, they also made it quite clear that human behavior is one of the main causes behind it. So I thought a great opener to our conversation today would be to talk a little bit about how we got here and what's gone wrong with capitalism. Graham, would you like to start out?
Nice short topic to take on first up, Dick. Someone will earn a Nobel Prize one day for unpacking many elements of this, but I think it starts with probably, if anyone's in the audience who's done Economics 101, and if they were sitting in the lecture theatre and they were listening to the concept of externalities be explained to them in economic theory in Economics 101, they would have heard externalities being mentioned. Externalities, things that you can push onto society or onto nature, the planet, while capturing as many of the profits for yourself as possible and your shareholders and your business. Fundamentally what we've got wrong with why environmental, social, and governance factors have finally begun to emerge as a discipline is because they've somehow been missed or kind of set to the side for too long. Some would say decades, others would argue centuries. And so we're just now seeing the investment practice start to catch up with where an investor, who's particularly a fundamental investor looking at all factors, developing their mosaic theory, they need to look at all factors that affect the going concern and pull the valuation back to price it today. And they can't ignore environmental, social, and governance factors.
Yeah, so, I would say that climate change does reflect the inability of capitalism and of governments to deal with a problem that is global in scope and long-term by nature. Corporate and government decisions both tend to be much more short-term oriented and kind of limited in scope. And here, so we have the IPCC report. It was unequivocal that human activity in the industrial era has caused climate change due to the burning of fossil fuels. Climate change is happening now, and people all over the world are directly experiencing it. And I might add, suffering from it. I just saw an estimate this weekend that in the U.S. this year, 1 in 3 people have experienced a severe weather event that can be attributed to global warming. And that's, so we're starting to I think, see a big change there in terms of just this idea of it, climate change moving from a long-term problem to a much shorter term problem. The report also says things are going to get worse, but that it's not too late to take action to avoid the most dire impacts. But that action needs to be taken soon, and to take action, it's an all hands on deck moment. It includes companies and investors, which are two groups that for the most part have been pretty uninterested in externalities and broader questions of impact, at least over the last era of investing, last 40, 50 years or so. And I think the crisis has now sort of shifted to a shorter term horizon problem that maybe we as humans are a bit better able to address, but we still haven't solved the problem of the sort of limited reach of governments. So there's a great need, I think, for unprecedented cooperation on that front. We'll see how the COP26 meetings go that are scheduled for Glasgow in November. But for corporations, especially those that are global in scope, I think it's clear that they will play a major role and must play a major role in either mitigating climate change or making it worse. But it's now for their own good, for their own long-term sustainability as businesses to take action. And to do that, they need their investors, their shareholders, to want them also to take action, to pressure them to take action. And the broad impact, I think, of the ESG movement, if I can call it that, is that corporations are receiving the message that their investor base is changing away from short-termers, away from those wanting only earnings and dividends growth without regard to externalities, towards those saying, we expect you to do better. We want to see at least a baseline of appropriate operations and management and corporate behavior that is sustainable over the long run, that generates profits, but also is good for people and planet. So I think ESG investors are playing a really significant role in this process of change towards a more sustainable version of global capitalism. But they aren't alone. They're aligned with other corporate stakeholders, customers and clients, workers, communities in which these companies do business throughout the world. And ultimately, yes, we still need decisive government action on issues like climate change and other externalities, but ESG investors, I think, are playing a very significant role, and one that encourages policymakers to take action.
So you spoke a little bit about the natural disasters, which we've been seeing around the world, and I guess that's bringing a lot of the focus on ESG investing on climate. But we all know that ESG investing goes way beyond climate, and you mentioned some of the things there. What do you see as kind of, or can you speak to maybe some of the key objectives of ESG investing beyond just climate? You mentioned some of the things that investors could be doing, but is there kind of, Graham, do you have any thoughts on what investors can be doing to effect change in ESG kind of beyond the topic of climate?
Well, and it starts with understanding that environmental, social, and governance factors, ESG, it's an abbreviation. It's not even an acronym. It covers a wide range of areas. And that's why I'm always very clear to describe an investor looking at all factors, including ESG factors. So it's not somewhere on the side. It's fundamental to how in the 21st century, in the realm of stakeholder capitalism or whatever version of capitalism is happening in your investment jurisdiction, you're looking at all the relevant factors to a business. And for example, if you look at the Sustainability Accounting Standards Board, one of the major frameworks developed for investors to look at ESG factors when they make their investment decisions, they begin from the premise of what do investors need to know? And they've looked at companies, they've worked with stakeholders, academics, intellectuals, to pull out, well, what are the material factors for a company in food and beverage, a company in transportation? What are the ESG factors that are most relevant? Now, not every company's primary impact will come from climate risk, but it'll show up in other and meaningful ways. For example, the trucking industry in the US. I was looking at some really shocking data recently, and I've just enjoyed a road trip across the US this past summer. I came through John's fair city of Chicago. And what is remarkable, firstly, 1 and 3 vehicles on the roads of America on 18-wheeler transporting something to somewhere. And every one of them has an ask, please come work for us. We need drivers. We are hiring. Now, something that really stuck out to me as this worked example of where logistics is and the cost of shipping, one of the promises was you would be home at night from one of the trucking companies. So very directly, while we look at e-commerce and we understand, yes, all logistics needs to electrify or find other means of propulsion, they must move away from internal combustion engines, which every time you use them are creating a greater problem of climate change. But there's also the social, the human problem, the governance problem of how do you manage a fleet of trucks and who are the humans who are looking to make that happen. And what you have is you have a raft of obesity among truck drivers, and you've got about 200,000 vacancies right now in the US of truck drivers who are just choosing not to do this. There are 3 million humans with C licenses that can drive a truck in the US right now. And there's a fraction of that who are actually filling those roles. And that's because the structural problem of how shipping is happening, how the truck driving industry has developed, has forgotten the humans. And so now those roles are basically the shipping companies are struggling to fill them. So every investment decision has environmental, social, and governance factors. Yes, it's important that Amazon's going to buy 100,000 electrical vehicles to deliver around the US. But equally, they spent $61 billion last year, 2020, on shipping, on the trucking, the flying, the moving of the products. But I don't see as much detail from Amazon, the standing company, on what is the human cost of how they've set up that business, how the algorithms are looking to squeeze the humans in that system. So environmental, social, governance factors on every investment decision. And so there's elements that are way beyond climate that a fundamental investor needs to understand as they look at their portfolio companies and how they do business.
I mean, it's such a great point, Graham. I mean, this idea of like, how do people fit into this? How do workers fit in to this? We've been through an era of capitalism where efficiency is the main thing, where investors have demanded that from the companies that they invest in, and now what happens to people? That's largely what the S in ESG is about. And you've got, it's not only in trucking, you see it in the hospitality industry post-COVID, where workers are starting to say, this is not working for us, and it's not working for society more broadly either. I do think it's important to remember when we're talking about ESG investing, though, at this point, worth saying, sustainable investing, ESG investing, whatever we call it, it's still investing. First and foremost, it is not primarily about activism. It is about taking into account issues and concerns facing the world today that are having an impact on your investments, and doing so in a systematic way. So the key objective to me here is to improve your investments, to make them more resilient to climate change and other material ESG risks, to identify higher quality companies, which in the 21st century, I think are those that attend to their ESG risks, and those that are taking steps really to embed sustainability into their long-term business model. And in general, the purpose of ESG investing is to invest in alignment with where the world is headed. And that's towards a more sustainable, low carbon global economy. Now, it just so happens that in the process of improving your investments by applying a sustainability lens to them, you're also coming to grips with the broader systemic implications of investing in your investments. And so, it raises that question. It's like, should investors continue to sort of wash their hands of the negative impacts of the investments they make? Should they demand a higher sort of minimum standard? And over the past era, it feels like to me, as long as a company is operating legally, that's pretty much been the minimum standard for investors. Should that standard be higher? I think we're seeing ESG investors expecting a higher level of a higher standard of company performance on these kinds of issues. And partly it's because they are people who are concerned about sustainability issues and about the long-term viability of their investments, and by extension, global capitalism, and want to improve it. But it all circles back to improving your investments, because if the system fails, all investments are going to suffer. So this is why we're seeing, I think, so much investor activity around pressuring companies, as shareholders, pressuring companies on sustainability issues. And this is, shows the promise, at least, I think, of helping us sort of lead us into a new era where public companies focus more on sustainability, are more purpose-driven, stakeholder-centric, and long-term oriented.
John, you mentioned that you think a key area is investors placing pressure on companies in terms of their sustainability commitments. I'm interested in more of your thinking around the most effective channels through which to affect change. Bearing in mind that a criticism of our industry is that we use engagement almost as a way to carry on investing in industries that have these externalities that you've both spoken to, without really committing to some of the urgent change that people feel is necessary. So what are your thoughts on that?
Yeah, I think that given what's been going on with the shareholder engagement, the ramping up of shareholder engagement, that the ability of shareholders to bring to the table others, NGOs and other groups that have extensive knowledge about these kinds of issues is helping companies better understand the issues and where the stakeholders stand on these issues. So, some have recently, I think, kind of tried to make the claim that ESG is a big distraction away from the need for decisive policy measures to address problems like climate change and other issues, other externalities that we've been referring to. And, I think kind of just the opposite. I think that when companies actually have to engage directly with well-informed shareholders about issues, it certainly causes them to sit up and take notice and to start to engage and figure out ways that they can address these issues, because they're sensing, again, that their shareholder base is full of ESG-oriented investors now. I mean, we had in the U.S. At company meetings this year, we had a record number of ESG-related shareholder proposals passed with majority support. It wasn't so long ago that 10, 15% support was considered kind of at least a minor victory among those who are engaging. So this has become, I think, a very important means for change. And I don't think it distracts or takes the pressure off policymakers at all. In fact, I think just the opposite. It causes policymakers to sit up and take notice that, wow, it used to be that investors didn't particularly seem to care about externalities in any kind of systematic way. And today it seems like just the opposite. So it feels like there's another set of stakeholders that policymakers are realizing want to see them respond to some of these issues like climate change.
What are your thoughts, Graham?
For me, it starts with investors doing their job, right? If you're taking other people's money and you're promising to be the best professional investment firm you can be, using whatever method or technology or systems, and putting that together to take a view of the prospects today, looking forward, pulling that future performance back, well, you've got to look at all the factors. You've got to look at the changing dynamics. You've got to look at where policy is going. And of course, why wouldn't you engage with any of the companies in your portfolio? In fact, if you're doing your job well, you would almost have a private equity mindset that depends on, how big your portfolio is. 30 companies. Yeah, you're probably pre-investment. You're having some kind of engagement, inquiry, conversation with them. You're clearly watching them. And a lot of the investors I've spoken to on the ESG and Coffee podcast are saying they run systems like this, where they're watching maybe 4 times as many companies that they actually hold in their concentrated portfolios. So for me, engagement is just a piece of doing your job. You're getting paid rather well for it if you look at the quality of the ties on this conference call, for example. So we expect the investment professional to do their job, and that includes speaking to the company. Now, there may be legitimate reasons why you don't want to. So I know some investors who don't want to, they feel in their approach, they become less objective when they build up some kind of relationship with the C-suite. And of course, remember, the CEO is salesperson number one, right? Whether she or he, came from whatever part of the business. So there are some nuances to this where you may choose not to be that close or that much in conversation with a particular company. But of course, if you pick up a particular issue, of course you want to be engaging with your portfolio company. All relationships end, and you want them to end well. At some point, you will divest of this particular company. The company itself and the entity that it has may delist or change in some way. So engagement is just a very critical piece of a healthy relationship. And another part of this is it's never been easier. It's never been easier to engage with portfolio companies on environmental, social, and governance issues, because there are just so many initiatives, collaborative initiatives, but with different investors working together. So they're not all repeating each other's work, they're actually collaborating. So for example, the FAIR initiative based out of London, working globally, that I've done some strategy work with. They've got 260 members, 38 trillion in assets under management. They're working with 107 companies. They're talking about deforestation, water scarcity, working conditions, and public health in the agribusiness sector. So more than ever, investors and asset owners have the opportunity to say, no, this issue of agribusiness, this is important. How are things being farmed, and what's that doing to the soil, and how well are the workers treated? Well, this is important to us. We should be part of this initiative. And then those conversations can go forward in a very structured and productive way.
Yeah, and I would just add, that's a great point, Graham. And I think that, when we think about engagement, and especially engagement as it is, relevant to sustainability issues, ESG issues, it's not just the sort of, I guess what I would call the standard engagement where you can call up, the CEO or the investor relations office and ask them a question about something, even have a meeting about it. I think when you're assessing asset managers on their active ownership activities, it's not only, how do you engage, how do you structure your engagements, how do you set your agenda for those engagements, but then also it extends to proxy voting. How do you use your proxy voting support the kinds of engagements that you are that you're doing, and it's a great way to show your investors that you are really behind a certain issue or an approach to issue, to make sure your proxy voting is in line, but also getting involved in these investor coalitions, I think is another step that asset managers and asset owners can take to enhance their engagement process, their whole this whole idea of active ownership, as well as back to public policy, as well as lobbying for promoting public policies that will help address these questions, not only from the asset manager and the asset owner doing so directly, but encouraging companies to focus their lobbying and government interactions, public policymaker interactions around these same issues. So engagement, I think, is when it comes to sustainability issues, has become a bigger, broader set of activities, and one that I think that if you're looking at how asset managers do their engagements, is a way to see how extensive and committed they are to these things.
For sure. You've both mentioned a policy, and I thought, John, you made an interesting point there that actually investor interest in ESG further promotes policy development as well. And Graham, you spoke to, looking at the direction which policy is headed, and that's something that I spend a lot of time on in my ESG research. And I think, particularly with COP26 coming up, we can expect to see more policy development in response to climate change and action on climate change. So I'm interested in your thoughts on what you think the key policy changes are that we need to actually achieve the Paris Climate Agreement, and also your view on, in terms of how you assess how likely those are to be implemented.
So speaking for myself first, whenever we talk about policy issues and the annual UNFCCC COP that's happening in November of this year in Glasgow, I'm reminded of Pippa Green's biography on Trevor Manuel, and it opens with a story and a comment by Trevor Manuel that these negotiations are basically the world championships of diplomacy in environmental and economic space. And oh, by the way, the players love to play, and they're going to be doing this for the rest of time. I hope not, right? I want to see real action come out of this. Where we are in terms of policy, significant changes are coming from the world's biggest economy, out of the US right now. So what we're seeing with the securities and Exchange Commission what they require from publicly listed companies, which will then have a trickle-down effect into privately listed companies and other types of asset classes, you're seeing an increased expectation that there will be reporting. So first of all, kind of the craziness of saying ESG is not important, therefore we want less ESG, that whole regime has kind of moved on now. So now we've got expectations that the task force for climate-related financial disclosures requirements are probably going to be baked in some form by the SEC when they come out with some proposals. It'll happen probably in Q4 of this year. So it's coming quite quickly. We know already New Zealand have that expectation right now. I mean, that's the only time we're going to say New Zealand could be better than South Africa. We won't talk about the rugby at all. But we know the UK in 2023 is coming through with some policies and regulations to map against this. So very quickly, there's some easy mechanisms with which policymakers can put in place legislation and then sanction regulation that helps to make that happen, looking at climate-related disclosures. Coming down the pike in 2023 is going to be nature-related financial disclosures. That's a whole nother piece that's coming. So in some ways, the hard work has been done by figuring out what are the key issues that need to be reported on. And now it's a case of legislators can really just pick up these elements that are immediately available and look to insert them into the appropriate legislation and then make sure there's a regulation happening against that. And from an investor point of view, for me, one nuance, one quality indicator of an institutional investor is if they're on the front of this issue or they're complaining about what is or is not legal and when they'll catch up and they propose to do X by Y date. No. It's 2021. We're facing a changing climate. We're facing economies that are stressed, societies that are changing. We need to see institutional investors with a long-term view moving at the front of these issues and helping put in place that legislation, showing up in the public discourse. So for example, when the Securities and Exchange Commission had their consultation that was open for 3 months, well, how many institutional investors were feeding into that? I know there were some crazies putting in some crazy comments because I reviewed them recently. So wherever there's the opportunity, as this legislation becomes to be evolved using already established frameworks, well, I want to see more of the institutional investors, asset owners, asset managers, asset consultants, all the players in the investment ecosystem showing up and supporting what's already possible, even as we need to look to catch up very quickly.
What I would add to that is from COP26, hopefully we're going to see some major additional commitments on carbon emissions reduction, greenhouse gas reductions, and by countries. And this is going to, I think, set a new standard and make it very clear to public companies that they need to set their own standards for emissions reductions. They need to do it soon, and they need to do it within the parameters that have been laid out at the IPC, at the COP26 meeting. And so I think that's very important because then investors in turn will kind of have their say on it, and it goes back to engagement and pressure on companies to take action on emissions reduction.
Thanks to you both. So I think Duke and I could sit here and ask you both questions all day, but we are running short of time. So Duke, I'm going to hand over to you to ask a final question or two.
Maybe you can touch on products a little bit, especially because we have John here. So it seems that a lot of these ESG and sustainability strategies have a growth tilt to them. And it almost seems like, growth in that sector is coming at the expense of some of the value strategy, perhaps, for the reasons that some of these traditional value sectors like energy and industrials are associated with high carbon. So how do you view this kind of growth versus value dynamic, when it comes to ESG and sustainable funds?
Yeah, I think on the one hand that there is a kind of growth dynamic to it in the sense that, and I think I mentioned this earlier, that in the 21st century, the definition of a quality growth company, I think, is going to include ESG performance as rapidly, is starting to already include ESG performance. How well is a company embedding sustainability into the long-term business strategy? So I think there's a certain, and then certainly when we look at how how, let's just say, how maybe easy it is for some types of companies to meet ESG standards. Certainly companies that tend to be in the growth reaches of the style box can do that more easily than value companies. So there is that kind of that sort of growth tilt in some ways. But I would say in principle, there is no reason why you cannot apply a sustainability lens to investments that typically would fit into the value space. And so because particularly trying to get a better handle on the ESG risks that are faced in these areas and engaging with companies about that, and then selecting companies at least partially based on who's doing better in these areas. So I don't think there's necessarily like, I wouldn't say that value investing has nothing to do with ESG. In fact, I think you could profitably apply an ESG lens there as well. There's a similar dynamic maybe with small cap versus large cap companies. Small cap companies, I think, have been given kind of a pass for a while about ESG. It's like, well, you're focusing on growing your business, you're focusing on those sorts of things. You don't have the time or the resources to focus on ESG. I think that's changing to where the message is more, and I think it's to some degrees coming out of private equity more too, is that you should be embedding good ESG practices in your business all along as you build the business. It'll be more successful that way than have to turn around later and realize that you've been creating a business by ignoring ESG issues and risks, and now you have to turn around and figure out how to deal with them better.
Anything to add to that, Graham?
I'd just pick up on the last point. Irrespective of your asset class, as you start the business, you want to be thinking whether you're looking for financing from a bank, on the fixed income side, or you're looking at something in terms of the balance sheet, and definitely with equity ownership. If you're embedding environmental, social, and governance factors from the beginning of how you start your firm, including all the way through to thinking about, do you want to become a B Corp and register in that way, which gives you a bit more latitude, so shall we say. That even if you're a private company, you're going to be in someone's supply chain. Even as we look back, for what Hurricane Katrina did in 2005, it changed the mindset of Walmart, because it changed the mindset of the board and the owners of the Walton family themselves, where they said, well, what kind of business are we? And so after that, Walmart very soon started a number of initiatives, including with CDP, where they looked at, well, what is the impact of our supply chain? So any supplier looking to sell into Walmart suddenly had to go, oh, hang on, we have to check these numbers. What is our footprint? What's the carbon intensity of what we're looking to sell to Walmart? So whether you were listed or unlisted, whatever asset class you're in, you could be farmland, could be property, more investors now want to know what your environmental, social, and governance performances, not just reporting. To be clear, a lot of the conversation gets hung up on the issue of, you need to disclose or comply, explain. Mm-hmm. No. Where the largest investors are and the most vocal investors are, they want to see the performance on what you're looking to do. And that can apply to a private company that will want to be listed one day, want to sell to a strategic buyer. If you've got better ESG disclosures and performance, you're going to get a better valuation. You're going to get your due diligence done faster, which will help you close a deal on better terms. So in any asset class, knowing more about the ESG performance of a company should make you make better investment decisions.
Thank you, Graham. Unfortunately, that's all we have time for. So John and Graham, I know I speak for Duke as well when I say this has been so interesting. So thank you so much for your time. And I do hope it will be the start of more conversations in the future.